Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, Josh, we're going to be talking about credit cards.
Oh, no, careful. I feel like that's like a thing like Beetlejuice, where if you say credit cards 3 times, Dave Ramsey will show up.
In the mirror.
Yes.
Or whatever. Okay, so I've never actually seen Beetlejuice.
Oh, man.
I mean, I'm a lot younger than you.
Parts of it on TV. I don't know if I really watched it all the way through.
It sounds disgusting.
Yeah. It's got, Michael Keaton in it. And
Yeah. It's from the, early 80s probably?
Yeah.
Anyway, so, credit cards. Interesting, very popular topic. Something we've probably
controversial.
It is controversial.
Some groups and realms of this financial world,
and we have opinions.
Yes.
Now these are our opinions.
Mm-hmm.
They are not fact. This is not like gospel. This is not black and white. You cannot make it just. This is what Josh and I think.
So, spoiler alert: when it gets down to the point where you ask, "What do we think?" Guess what I'm going to say. It all depends on your situation.
Depends on what you want to do.
Yeah,
that's kind of the way it works. So, just kind of take a second and go 50,000 feet.
Yes.
What are credit cards?
Yeah.
What is a credit card?
Yeah, so simply, it's a card, usually plastic, that offers some form of credit in that a business or entity is willing to pay for transactions right now for you as long as you promise to pay them back with a little interest later on.
Or a lot of interest.
Yes. So the idea there is instead of you having cash in hand, you have this card that's, in a sense, somebody promising that they'll make sure that it gets paid, and then it's their responsibility to get paid back from you.
Yep.
And so it's really a way of extending credit, and we've talked about credit when we talked about mortgages and stuff. It's a way of just saying, okay, there's this line that says, okay, you're worth or you have the ability to pay this amount, so we're going to trust that, and we're going to extend that you can make purchases without actually having the cash in hand.
Yep. So to bring it back to your earlier funny joke about Dave Ramsey, Why does Dave Ramsey hate credit cards? Yes. It's because it is debt.
Yes. Yeah, you owe somebody something.
Yes.
Now, it could be for 30 days. It could be for 10 years, depending on how you pay your credit card back.
It is not taking your money out of your checking account or cash or whatever to buy that item. You are saying, I owe you for this purchase I'm making right now, and I'll pay you whenever, either next month or over time, or however people decide to do that. That's why people like Dave Ramsey are against it.
Yes, and what he recommends is called a debit card. And the difference there is a debit card actually deducts or debits out of your checking account or savings account the money right away.
Yep.
And so you can only put on your debit card or transact the amount of money you have in your account.
Absolutely.
Or else you overdraw and you get in trouble.
Yeah.
So that's the difference. A credit card, you are making purchases on credit, meaning it's a future obligation. A debit card, you're currently debiting out of your cash the expense.
It's really about calendarizing when that money comes out.
Yes.
Because all other things equal, if you pay off the statement balance or whatever, which we're going to talk about later, you're either just paying for little chunks here and there as you spend the money with a debit card, or you're not doing that, but then at the end of the month or whenever your due date's set, boom, all of it hits at once.
That's correct, yep.
So I guess let's kind of also discuss how credit card issuers make money, because we say it a lot, but there is no free lunch.
Correct.
So credit card companies like to make money, right? These are some of the biggest publicly traded companies out there, a lot of them. And how do they make money? Well, first of all, they don't make money off of everyone.
Right. So there's actually 2 ways. And we should start by saying there's kind of 2 different groups of credit cards.
Correct.
So Visa and MasterCard, you see those. If you look at, for instance, if you get a card from a bank, it'll say Visa or MasterCard on it.
Yep.
More likely than not. Then there's American Express and Discover cards.
Correct.
Those are a little different. They're all credit cards in that you're, same like we explained, they're paying and then you pay them back down the road. The big difference between the two is Visa and MasterCard do not take the credit risk themselves. Whoever issues the card, whether it's a bank or whatever, usually it's a bank or a store, will issue a card, but it'll have a Visa or MasterCard on it.
Capital
they're
One,
the ones,
JP Morgan, those kind of things.
They're the ones taking the risk.
Yeah.
Whereas American Express and Discover, while they will do that with some places, more often than not, they're the ones taking the risk.
Correct.
They're the bank backing those credit cards. So American Express and Discover are actually financing it themselves.
Right.
So there's two different ones. And you're right. So if you pay off your balance every month, no interest accrues. So from, let's say yours is on a normal month schedule from the 1st to the 31st. Any transaction that happened that time, you'll get a credit card statement that says, here's how much you owe because here's all the transactions you made during this time period. You then have 30 days to pay this off. And at the end of those 30 days, we'll start charging interest. But through that time, interest free.
Right.
So in a sense, it'd be the same as paying. It'd be the same as paying cash, except for like Austin said, you're letting it lump into that one payment at the end to one person. So they don't make any money off of interest from you.
But what these companies are banking on, see what I did there? Banking. Aside from the fact that some of them do have like fees, like every year you have to pay an annual fee of $100 or $200. Some of them are kind of expensive on some of those American Express cards or whatever.
Yep.
But that is one way that these card companies can make money. But another is that taking into consideration that a lot of people aren't going to carry a balance, they're going to pay it off every month and not get charged any interest.
Yep.
That's like they have to take that into consideration. But they're counting on the fact that more people are going to carry a balance and that these people are going to accrue interest every single month, and that's going to outweigh the benefits that they're giving you in terms of rewards and what they're going to be not, getting any benefit from those people who just, use it and pay it off.
Yep. And on top of that, there's also transactional costs that these people get. So, if I go to the store and I use my credit card and make a transaction, if it's a MasterCard gets a small fee from the store to process this transaction, and it covers the expenses and all that stuff that they do. So they make money on the other end. So even if I pay zero interest on a credit card that I have, they still make money from me, but not directly from me, but through me using that card as transactions. But it's paid through by the store. So that's why a lot of times stores will have a minimum to use a credit card because they know it's going to cost me this much dollars. So in order to make it profitable for me, you'd have to spend more than $5 here to use a credit card, whatever they do.
Yeah, and I think that's something to... So it's easy to think that, hey, you're not paying for that, but you really are because prices are then just probably a little bit higher.
They build into it.
To cover that. And yeah, it's definitely not completely free. I think the example or the numbers that I've heard is like 1% to 3% or something like that, depending on how big your company is. You can get better rates and stuff like that. But that's
and
kind
which
of what's
one you
typical.
use. And so you have Visa, MasterCard, Discover, American Express. So there's 4 networks right there. If you want all 4, you're going to have to negotiate each one. And that was part of for a while you went to a store. Maybe they only had 1 or 2 of those. Is based on what rates they could get, some were just not worth it.
And this does not even take into consideration like things like Stripe or whatever, where that's kind of a conglomerate where you can sign up for that service, use their little hardware, and you can use all of these things, and then you pay them a fee, which then they pay a fee to all of these different providers.
Yep.
So all kinds of things there. So Josh, why would someone want to utilize a credit card perhaps?
Yeah, so there was a good article out there from moneyunder30.com, which we'll link in the show notes, and they listed some reasons why they feel...
Me, money under 30.
Yeah, under 30. I'm not, so I can't read this article. They listed some ideas and kind of matched kind of what Austin and I were thinking, and so we're just going to go through those. One is it helps you build credit. So we'll do a future episode about credit scores in general and kind of what those are and what you need to know about them. But credit is used, again, credit card. Credit is just the ability, how much money you can borrow or kind of have outstanding based on your income and your history.
Yep.
And so building your credit history is important. It shows that you do have the ability to pay back and you consistently do that.
Yep.
So a credit card is actually good in that it does build a history because you owe somebody money, whether it's just for 30 days or however long. And if you can pay, make sure you make monthly payments, make sure you don't miss a payment, you actually build positive credit.
Yeah, and that can help you down the road as you're looking for, maybe you want to buy a house, maybe you want to buy a car, whatever those are. Not that we're saying take out a car loan, but the house is a really good example of if you have a better credit score throughout a variety of factors, which, again, we should probably do a full episode on credit scores, but you will get a better rate, better terms, and stuff like that. So very favorable. And
whereas we mentioned the debit card is the alternative way of making electronic purchases, debit card does not build credit because you're not borrowing. It's your money when you make those transactions. Another reason
would be called a debit score?
A debit score, yeah, I guess. Take what you can owe, so what you can pay. The next thing is credit cards offer rewards programs or cash back, some sort of incentive to use their card.
Right.
They're competing against other credit cards out there, and so they have programs to entice you to use them. And so it may be a rewards that you accrue points, whether it's miles for airline tickets, points for all these different, maybe they give you a brochure or pamphlet of all the things you can order, or in a lot of cases, just straight cash back. So if you get 2% cash back, every transaction, 2% of that is returned to you.
Yep.
As a form of, you can reduce your monthly, what you owe, or, send straight cash back.
Yeah, exactly. Another reason that both individuals and businesses is one that comes to mind, is really simple, is that this is one easy way to track your spending in one place. So you don't have to log into your bank and then go through, I've got all of these checks that were sent out, and then I've got my mortgage ACH transaction, and I've got yada, 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 and then find your actual transactions. Nope, it's all right there.
Yep.
And a lot of credit card providers have very cool apps and things within their website even where it can categorize and help you see things.
Yep, and that's huge when you're looking at your budget. How much did I spend on food? Well, if you use your credit card for food and other expenses, you can break down, I used X% of my total spending was on groceries or whatever like that. So it's very helpful when it comes to budgeting to say, okay, where am I spending my money and how much is going to each spot? They do offer additional protections. So credit cards, and I encourage you, if you do have a credit card, look through all these different things that it offers. A lot of people don't take advantage of them. So purchase protection, that's huge. So if I have a 3-year warranty, but my credit card offers an additional year warranty, I get another year just for using a credit card to make the purchase. It also is helpful in, let's say I did not purchase something and it shows up on my credit card.
Exactly.
In a sense, fraud, they offer a protection program with that as well. Because again, they're that in between. You're repaying them, and they're the ones that they'll make it right with the company or the store, where that fraud happens.
And particularly with those things, it's much easier to reverse some of those fraudulent charges or whatever with a debit or with a credit card than it is with a debit card. Because with a debit card, if someone
it's out, your money's gone.
Yeah, if someone hacks your account and spends $2,000 on a new TV, your checking account has $2,000 less dollars in it, and that's a lot.
And you may eventually get it back, but it may be a while, and you're going to need that.
Or with a credit card, boom, they can just flip a switch and it's gone. So and before you even get a bill.
Yes.
So that's kind of nice.
On top of that, insurance. So again, depending on what your credit card is, they may offer travel insurance. So if, let's say I book a vacation, my credit card, if I use that, may offer additional insurance protection for if I can't make it or something happens. And then along with that, if I'm overseas, they have certain insurance plans in place just through my credit card. I don't have to get additional insurance packages to cover it.
So like when the Invested Dads record a live episode from the beach in the Bahamas?
That would be, we'll have to use our credit cards if we have any to make sure we get all of our insurance protected.
Another benefit is that generally speaking, nowadays, they're accepted pretty much everywhere.
Yes.
Even small businesses have great, access to be able to accept credit cards. Most major, like we said, Visa, MasterCard, American Express, Discover, those are pretty much accepted everywhere.
And some places will not take a debit card. So if you think of hotels in particular, some will take debit, but they're going to place a hold. It's in a sense in case you destroy their hotel room.
Yeah.
They're going to put a larger block on your card, again, because that's your money. They know that's their only chance of getting it back. Whereas with a credit card company, they have the ability to negotiate and work through that.
Yep.
So a lot of places, they prefer or only take a credit card as a way of booking.
Yeah, anything where holds or deposits are, it's definitely much easier with a credit card. And returns. Mm-hmm. When you return something on a credit card, it is much faster, and it's just a much more smooth process where a lot of times that can be taken care of before it even hits the statement, and it's just a wash, where it takes a lot longer when you're actually dealing with someone's checking account through a debit card.
Yep. So let's flip it. What are some reasons not to own a credit card?
Yeah, so there was also a cool article on moneycrashers.com, which we'll also link in the show notes. They had some opposing views on this and some that we would agree with as well. Yeah. So number one is there is a concern about overspending because it's really easy to just go swipe a card and you can and if you don't have to see it come out of your checking account or whatever, you can let things rack up and if you're not getting in the app all the time to look at your credit card, whatever, it'll just keep going. Mm-hmm. And then you'll get hit with a huge bill.
Yes.
So that is a concern. And that's kind of, one of the reasons that Dave Ramsey's kind of not a fan of this is the ease of spending with credit cards has really made overspending really easy because you're just less attached to your money. Whether that be debit and you see it come out of your checking account or that be hard cash where you're like, oh, do I really want to spend that?
Yep. And a debit card, you stop when you run out of money. You could try a debit card, and if you're out of money, it says no. It says no. Whereas a credit card, it'll keep going until you hit your limit. And most credit card companies, their limit is pretty generous. They want to make sure, obviously that comes back to the credit score and where you're at.
Right.
But, most of the time, if you look at what your credit limit is, it'll be higher than you probably want to spend in a month. Exactly. Whereas you could just keep going. They're not going to stop you until you hit that.
Another one is that so if you think about things like a car or a house, these are tangible assets that generally hold their value somewhat well. There's depreciation on cars, but typically appreciation on houses. So rates when you borrow to buy these things can generally be pretty low relative to a credit card, like we're talking about here, where the credit card company, if you go buy a $5,000 100-inch flat screen TV for your basement. You got to watch Trolls in 6K.
Awesome. Yes, right.
And so you do that, and the credit card company is not going to come and take your TV if you don't pay your bill. You're just going to keep accruing interest, and then they don't have hard assets. They're not going to go back on hard assets, is what I'm trying to say. So that's why the interest rates are a lot higher, and those interest rates can be huge.
They're in the 20s. I mean, they're mid-20s.
So if you think about how interest is calculated, it's similar to other ways that interest is calculated. But if your APR, annual purchase rate, is 25%, then you're getting charged every month 1/12 of 25% on your outstanding balance.
Which is a lot.
That's a lot.
It grows fast. Yep.
And it does. We love compound interest, but that's when you're growing your money.
In your favor, yes.
But when it's compound interest on debt,
nope.
I'm shaking my head.
Yeah, no. And if you ever look, credit card statements usually will show you. But if you ever look to see how long will it take if I only pay the minimum? Because again, the minimum is not paying off your balance. It's just the minimum amount they'll accept to keep you current.
Right.
And that is usually 7, 10, 12 years down the road before you pay that amount off. Not in counting any new stuff you'd put on that card.
Think about how expensive that TV could get if you don't pay it off right away.
Yes.
You're going to be paying, just like your house has, multiples of because of the interest, you can have multiples of the things you purchase because of interest.
And that really is the biggest reason not to have a credit card is they're not looking out for your financial well-being because they'll make money as you struggle to get back on firm footing. That's the biggest downfall for credit cards is they'll continue to grab that interest and they are not going to be too concerned about it because you agreed to this contract and they will continue to charge you as long as they can.
Yeah, so it's just good to know that there are other options to pay.
Yes.
And it depends on how you are is probably what it boils down to, and we'll talk about that in a little bit. But just know there are other options.
You got checks, which are awesome.
Oh, don't even
sit down and write a check out in the convenience line while people are behind you watching.
So balancing a checkbook.
Yes.
Have you ever done it?
Like on my head or
no? Like
in the back of the numbers book. Work. Oh, okay, yeah. Because
you've done it.
Oh yeah. You
still do it?
Well, so. True story, I used to help my grandma balance her checkbook when, later after my grandpa passed away, and I'd go over and reconcile it all for her. But she did everything. It was, for me, I use online banking. Yeah. That's the way. So, my actual checkbook does not have a continuous balance.
Well, it has all the blank pages at the back that you never use.
Well, so I do use the ledger where when I write a check, I track all that, but I don't follow through with the current balance because nowadays with debit cards and all that, more money comes out than that's showing in that ledger. Yeah. And so it's just to reconcile that would be a pain.
Yeah. I was talking, this was a few years ago. And so I was talking to my mom and I was like, I ordered some new checks, and she said, "Hey, yeah, how often do you balance your checkbook or something?" And I was like, "I have never balanced my checkbook because I log in, maybe not daily, but very, very frequently to my checking account
check on
to
things.
see what's going on." And nowadays with ACH transactions and automatic bill pay and those kind of things, like I know
Is that the Affordable Care hat?
The Affordable Care Act, of course. Yeah. Oh, Josh, you made me mumble. Yeah, so automatic clearinghouse. Is that right?
Yeah,
Automated clearinghouse?
Maybe.
Yeah,
Is that the one where they had like that prize that you do? No, that's the publishing clearinghouse. Never mind.
The big check. A big fat check.
A big giant check.
Yeah. So I was like, Mom, I've never balanced my checkbook, but I've never missed anything because I log in so much and I know what checks are coming. I mean, I write checks when I go to the BMV because if you use a card, you get charged more.
You do.
I physically write checks for, that might be it. Like
our
very
trash pickup service was check only.
Yeah.
And they're just now switching to automatic, which I'm pretty excited about.
See, we bank through Huntington, and they have automatic bill pay, so you can just it mails a check for you.
Yep.
So I started
I do
using
that for a couple. Yeah.
I started using that for. So anyway, yeah, that's checks. That's a sidebar
checks.
on
No,
checks.
oh, man.
But Josh,
Back to credit
cards.
Is that what we're talking about?
Well, I think you're about to make me laugh.
I am. All right. So, speaking of all that, do you know why bowls are very bad with debt?
I have no clue.
Because they always want to charge it. That's my joke.
I don't get it.
The bowls are always charging at things, but they're charging it as in putting it on. So it's a credit card joke, but
Okay.
It's
Josh,
it's not
I
the
was
best.
thinking of
They
like a
charge it.
cereal bowl.
Oh, I'm sorry. I should clarify that. Let's redo the dad joke.
No.
No, you don't want to. I could just say the animal, the bowl, or the cow, but the bowl is the one that charges.
I was like,
You're like, why is the bowl cereal bowl want to charge you anything?
it's funnier when you explain it.
When you know it's a bowl, as in an animal, then you understand.
that
They're
joke
charging
makes a
it.
lot more sense.
Oh man,
All right, so credit
failed on
cards,
that dad joke.
Charging
Yeah.
it. So rewards are a huge reason that people use credit cards.
I would venture to say if there wasn't rewards,
Why would you use it?
why? Besides the protection piece,
Yeah.
which now a lot of debit cards will have some sort of protection built into it. They'll have like a some sort of, like for instance, my bank, I have someone that I can contact if there's a problem, and they're usually pretty quick to at least freeze it and start the process. But you're right, between instantaneous and a couple weeks, it matters.
Yeah.
But yeah, the rewards is the big appeal for credit cards.
Right.
And so we looked at, I mentioned cashback, miles, points,
Sometimes discounts.
and that's usually on top of as well. Like,
Yeah.
They'll give you an additional thing. So, what do you think? Of those lists, cashback, miles, points, which one is most appealing to you?
Cashback.
You like the cashback?
For sure. And we're going to talk about how we and our families manage this later on, but that's the biggest
That's it.
one that I use.
Yep.
What about you?
So there's cashback is huge because it's just straight dollars in your pocket.
I like dollars.
But for us, miles is we're talking about, but I do have a Delta credit card, and those miles are great when we're buying tickets to fly. I have 4 kids, so that's 6 people flying. It can get expensive. So to cut down that cost is huge. And if you use Delta, then I don't have to pay for the check bag. So then every single one of my kids can have a check bag. I don't have to try to jam it all in and stay under that.
So that means that means your kids each get their carry-on, you get your carry-on, and then Steph can bring whatever she wants.
That's right. Yes.
That's the way it would go in my family anyway.
Yes.
It would be like
She gets all her
Juliana
suitcases.
and I would have like our little carry-on bag, and then Jenna would.
So we went
you,
on
baby.
a trip and we drove, but it was like I had a small carry-on suitcase.
Yeah.
Kids had small carry-on suitcases, and then Steph had a giant suitcase.
I mean, I can live.
We're going to the beach.
out of
you
a
need a swimsuit.
Yeah, I know.
and
Out of a
towel.
carry-on bag, I can live for like 2 weeks.
Yeah, it's crazy.
And I hate baggage claim.
I used to not mind until we lost our luggage on a trip that was.
I remember
Oh
that.
man, yeah.
Baltimore? Was that
we
where you
went
went or
from
something?
Detroit to Baltimore.
Yeah.
So it's a short flight, but we had free.
like an
we had
hour.
we had a free flight, so we that's where we went to a football game, but we lost our luggage on that flight, and it took us 2 days before it landed back. When we were heading back home, it was back in Detroit for us, but our bags went to Florida. Orlando, went
They
to
got a
Disney
vacation.
World, went to Disney World and back before we saw them again.
Oh, that is funny. So there are some other features that credit cards also offer in addition to what we've already talked about. Number one is promotions. So to get you on board, a lot of credit card companies will offer you some large cashback bonuses. They're like, hey, if you spend $2,000 in the first 2 months or whatever, here's $100 or something like that. That's kind of cool sometimes if you were already in the market. But that can, these are all ways to entice you to either spend more than you need or to just sign up for their business anyway. So like you have to see it from, it's a sales pitch.
Yes.
Another one is a lot of companies, and I'm not condoning this, but a lot of companies offer like rollovers where you can bring another balance from another card onto their card, and you're going to pay a small fee in terms of percentage on that. And there can be a period where that's interest-free or whatever. This can actually be used for good. If you have a high-interest credit card that's accruing a bunch of interest, and for a 3% fee or whatever, you can roll the balance onto a 0% for 24 months or something.
Someone will do it for free now, too.
Oh, really?
Yeah, with no fee. They'll accept balance transfers for no cost, and then you can get like an introductory period where it's zero or low interest.
So that may be worth looking into. It's not a habit that's probably good to
but if you're in that spot,
Exactly.
check around that you may be able to get at least a temporary reprieve from that accruing interest at a high rate.
So we mentioned credit scores earlier. Now, using, paying off, opening credit cards, these actions can all have impacts on your credit score.
Yes.
So there's pros and cons, right? This can go both ways for you. So Josh, what are some pros to having or opening up a new credit card or whatever?
Yes. So the pro from a credit score standpoint and looking at it is you have more available credit now. I have a credit card and let's say they give me a $5,000 credit limit. And so I can now have this credit of $5,000. So a positive for it is it will build my score over time as if I'm consistently pay off and have no late or unpaid balance on there. So that's great for. On top of that is that $5,000 amount is looked at, okay, if he can manage that, maybe he can manage more, and it could build your credit score up and build your available balance up as well. And so that if you need it, then let's say you down the road, you say, oh, I know I'm going to be remodeling my house. And so if I can get my available credit up to $10,000, I'll be able to do this whole remodel, and I know I'll be able to pay it off, and I can negotiate. And some now allow you to build like a payback plan where I know I'm going to have a bunch of expensive loans. I can group it into one cost, and then I'll negotiate or have a deal with my credit card company saying, okay, just this amount here, can I pay this over a certain amount of time at X percent interest, or some are even now offering 0% interest, again, like a plan. So then you can really, essentially, utilize that credit that you have available.
Yeah, the key there is the credit utilization versus available credit.
Yes.
So creditors want that to be, when they're signing you up, want that to be low. And it being low would be beneficial for your credit score. So if you have, between all your credit cards or whatever and all your outstanding available credit, $10,000 of available credit, if you are using up $3,000 per month, you have $7,000 left over.
Yep.
Well, if you then get another card and you can add another $2,000 or $3,000 on top of that without really using more, then your available credit goes up and your utilization rate goes down, which is a very benefit for your score there. But there are downsides to credit scores, to how credit cards can impact your credit score. So first of all, you get dinged on your credit score when you open too many new accounts, or you have inquiries into your credit score.
Most inquiries don't impact your score. It's when you actually process and open it.
Gotcha.
So let's say I go to a car dealership, I'm looking to buy a car, and just as part of their process, they do a quick credit check on me. Those type of things have zero impact because they're just inquiring, hey, where are they at? But if I go through the process,
application.
The application itself is where you'll get hit. And if there's especially multiple ones in a row, that could say, okay, if all these come true, there's going to be a lot of pressure put on that utilization, and you could be in trouble. So that will impact your score.
Another thing is average length of accounts. So one thing that goes as a factor into your credit score is average length of credit established. And if you open up a new account, then that is a new account that is really, really short. So that lowers your average length of your credit. And what I would caution against is even if you open up a new account and you close an old one, that closed old one's going to do the opposite too. You're going to shorten it as well. So you could double ding yourself. And creditors, so people who are issuing credit, want a lengthy period of credit established.
And we talked about this in the college podcast where we talked with a college student, Maddie. We talked about one of the things as a young person heading into the world is if you want to build credit, this is an easy way to do it. Most of the time you can qualify for a credit card as long as you have income. More often than not, you can get some sort of credit card. And so getting one and just putting a couple transactions on there just to get the credit history started is useful if you think you're going to need that credit down the road.
Yeah, keep it simple. So like if you are just getting started, maybe look at what your options are for credit cards that are out there. Find something that has some maybe attractive perks or whatever.
But free.
But do something simple like, hey, I'm going to put my gas on this only. Yep. And that kind of gets you in the habit of it's going to be paid off all the time. And the tip, and we're starting tips section here.
This is it.
Here's the tip. Biggest tip. Set up auto pay for your monthly statement balance so you never, ever, 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 ever pay interest.
When should I pay interest?
Never, ever, 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 ever. Never pay interest.
Nope.
Set it up, auto pay.
Yep.
That's not optional.
Yeah.
You have to do it.
Most credit cards with all their fun online and apps, it's pretty easy to do. You link a bank account, you say, okay, here's my statement date, here's when I want to pay the full balance or your statement balance, call it a day.
Exactly. Also, fun tip is just keep mindful when you're at the store or when you're spending using your credit card because, like we've said, it's easy to spend more money because you're not seeing it come out of your checking right away.
If you hand dollars over, you see those leave, and they leave you and go to the other person.
And it's kind of
when you use a credit card, it just doesn't seem as real.
Exactly. So be mindful of what you spend. Also, know when the payment will get drawn or withdrawn from your checking account. So know that every month on the 22nd, my credit card bill goes out. And this really becomes important if you have more than one, knowing all the time when those come out and making sure that you have the income or the cash flow to kind of be able to consistently provide for that.
Correct.
Josh, one more tip.
Yes. Set up auto payment.
What?
That's the same as the first one, but it's so important. We're going to make it another one. It's really just, we can't stress this enough. The biggest impact on your credit, on the interest rate, and everything is missing a payment.
Don't do it.
Don't
There's
miss
no
a payment.
reason.
Nope. And if you think you might, then maybe you're not ready for a full credit card. Stick with the debit card, stick with the cash, because the impact long term. And by the way, Jess wrote a blog on the Everyday Advisor about this, and she talked about the one time she had an issue like that and just a process to get back from there. And so, she was honest and open about, here I am as a financial advisor and something happened. And so if you want to read it, it's a great blog post. We'll note that in the show notes as well. But if you're worried about that, if you have inconsistency with doing that and you, for whatever reason, don't want to set it up to do it automatically monthly, or you can't, maybe you have a inconsistent revenue income stream from your job, then maybe stick with the debit card cash for now.
And that's kind of an overarching theme is that, if the credit cards can be a useful tool, but they take a bit more discipline on the front end and ongoing even to do it right. Now, they can have some benefits and do well for you, but you do have to be a little bit more mindful where if you're only limited to what you've got in your checking account with your debit card, then that's it. That's what you got. So just a little bit more discipline might be involved there. So, Josh, what do you do personally and you and your family?
Yes. So we have two main credit cards, and I guess just start with my brain works in buckets, and so I like to put things in groupings, and that's kind of how I work. And so we have two primary credit cards, one that's used for our reoccurring, so utilities, anything that's reoccurring bills, from insurance all the way through, anything that I can set up automatically that will accept a credit card is on one credit card, and it gets paid off every month. And that's just a way that I track that grouping, so I know how much I'm being spent on those reoccurring costs. Then we have a second credit card that is used for our more discretionary stuff, so gas and groceries and those type of things, and that has a cash back or a percent back on groceries. So you kind of utilize the card for what it's good for. But then that one has more of a variable in the balance. Because it just depends on what we do that month. And so that's kind of how we track those two. And then I just opened, thanks to Austin and I talking, he gave me this recommendation. Amazon has a credit card and you get 5% back on Amazon purchases. It's crazy. And so we just opened it, but we do a lot of our shopping on Amazon, and we do some of that where they deliver the home or what, I forget the Amazon Prime, or what's
Prime Wardrobe?
No, not the wardrobe, like the groceries. Fresh.
Oh, subscribe. Yeah.
It's the subscribe things. Yeah. The subscribe and save or whatever.
Yep.
And so, there's certain items that just get delivered. We have dog food and a couple things that get delivered. So just automate that, but we'll get 5% now. It's just saving some money. But again, with the intent to pay that off every month. And then finally, I realized, because when we were talking about this thing, I went kind of back and looked, we have a Kohl's, which is a credit card.
Yeah.
They'll talk like store cards, but it's a credit card.
That is a credit card.
And so we, again, use that because you get those Kohl's cash and whatever. Exactly. And again, it's the kind of idea where ideally you say, okay, I have all the cash right here for my purchase, whatever at Kohl's. I'm going to use the card and
get a discount.
You can actually go after you pay
it there.
Walk it to the back of the store and pay it, and then walk out and you're done. Yeah. So you utilize those type of things. Take advantage of what they offer to get the best benefit and best deal, but just be mindful and wary. If I get to the point where I'm worried about any of those, they're gone, and I'm going to do something else.
Exactly.
But for now, that's where I'm at. Yep. What about you, Austin?
Similar. So I'm a bucketer. I'm a cashback maximizer is kind of the way I view it. So we have all things set up to pay the thing off every month. That's kind of the way we roll. But we have probably like 3 main cards that we use, and I had to get my wallet out.
All right, get your wallet out.
So we're Costco members.
Costco.
So we have the Costco Visa, and the Costco Visa we like because on gas we get like 5% cash back, and on restaurants we get 3% cash back. So that's for gas and restaurants. Yep. Then we have an American Express something cash back thing, which gets like 5% on groceries.
There you go.
So we're getting up there in cash back. Then we have a Capital One Quicksilver, which is 1.5% cash back on, and we use that on miscellaneous things that it doesn't fit other buckets. Yep. And then we do have the Amazon card because we order a lot of things on Amazon, and 5% is a lot. I mean, that's you cannot say no to 5%.
Good savings.
And then we also have, we have our Apple cards because we're Apple gurus, and we use that to get for all of our Apple services. And when we buy Apple products, we can get better cash back from Apple.
There you go.
So it's cash back maximization. That's a mouthful. Whew. But we've gone. I'll say that I truly feel there's no right or wrong way to do this because I feel like sometimes I do a lot of work for the cash back when I don't know. Maybe it's worth it. Maybe it's not. I like the cash back. It's free money.
Yes.
But we've gone back and forth probably a couple times since we've been married where we've got these credit cards, which we do exactly this, and we maximize our cash back, and it's great. And then we're like, I'd kind of like to not have those big swings when the bills come due, and we just go with debit card only for a while. And then we'll be like, I want some cash back again, and we'll start doing the credit cards again. And I think both are good.
Yep.
I really think both are good, and it depends on where you're at in life.
And it depends on budgeting, too. So I know for my wife and I, doing actual cash in envelopes where you kind of say, okay, this is how much I want to spend on groceries. This is how much I want to spend on entertainment or whatever. And you actually put physical cash in each of those envelopes, and then when you're going to do it, that's what you use. It makes you so mindful of what you're spending, and it makes you say, okay, there's only $20 left in this, and I got to get 2 more weeks worth. Is this really worth it?
Yeah.
And it makes you, whereas if you had a credit card, you probably wouldn't even know, for one. And then 2, it's a lot easier to say, well, I'll be all right because I can borrow from next month or whatever. And so actual cash is great for budgeting. And so we're the same ways. Depending on where we're at, what's going on, sometimes it just makes more sense to slow down the credit cards and switch to something different. But I'll tell you from firsthand knowledge, if you really do struggle with the budgeting and the spending aspect, cash is king.
Oh, yeah.
Because even with the debit card, you can lose track of where it's at and be spending something else that needs to be there for later. I can say, well, I still have $200 left in my checking account, but what if you have a $100 bill coming from utilities,
right?
And there's not enough left. So cash to me is huge. So if you are struggling, that's where I would suggest at least start with and go there until you get a better consistency and I have leftover money at the end of the month.
And I'll be the first to admit, I think we probably do spend a couple dollars more having credit cards because it's easier. And if I'm at the grocery store and I'm literally forking out $20 bills for my $100 grocery trip or whatever, I'll probably be more apt to put something that I just threw in the cart back.
Yes.
Because I'm paying cash. But if I've got my card, I'm just going to get it.
It's all right. Yep.
So, yeah, I think it really comes down to who everyone's different.
Yep.
So I guess that's the question. So what do we suggest people do?
Yeah. Well, like I said at the beginning, it really depends on your situation.
Or you can do both.
You can do both. And I think that really, what it comes down to is credit cards are convenience. And that's really what they're designed for and why they exist, is that they do offer very good convenience. If you're going to struggle with those other things that we talked about, especially the spending and the budgeting, I would just say hold off on credit cards.
Right.
If you need credit or need to build credit, it's the best, in my opinion, the easiest way to do it. There's other ways to build credit, but this is an easy way to do it. And then again, if you're worried about protection, whether it be someone stealing your identity or whatever, credit cards do offer an extra layer of protection, and as well as purchases and those type of things. So again, it comes back to where are you at in your life situation? How are you with handling finances? And then decide from there.
Yep. Awesome. Well, that's credit cards for you. As always, check out our free gift to you. It's a brief list of 8 principles of timeless investing. It's on our website. It's free. These are some overarching investment themes meant to keep you on track to meet your long-term goals. Check it out. Josh, how can people support us and help us to grow this podcast to continue to bring these episodes out each week?
Yep. Make sure you subscribe. That alerts you whenever we do a new podcast every Thursday. And then also Apple Podcasts, if you listen on Apple,
which most people do.
A lot of people do. That's a great way to help us rank higher. Ranking higher just helps us reach more people.
So leave a review on there.
Yes. So reviewing on Apple Podcasts is huge. Email us any ideas you have at hello@theinvesteddads.com. You can get there also from our website, theinvesteddads.com. We love responding to questions or ideas. That's what we love talking about.
Yeah, absolutely. And if you found this episode particularly interesting, or if you've had some interesting discussions about credit cards with family or friends, just hit that share button and share this episode with them. Maybe they can learn something as well.
All right. Thank you. We will talk to you next week.
All right. Thanks. Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.